Howdy, Jacob here. Today we're looking at Entergy Corporation, ticker symbol ETR. Looks like 4.43% dividend yield, $21.6 billion market cap with a $44.7 billion enterprise value, a lot of net debt. It's in the electric utilities business. Looks not super cheap, just a market average, almost 14.7 P, 1.6 price to book. A little bit increase from 2013 to 2022, but even 2013 to 2020, it looks like it went down. Return on invested capital, very shoddy at best, sub 4%. Let's look at that long term debt. All right, so almost doubled from 10 years ago, 2012, 11.9 billion, and in 2022, 23.6 billion. Looks like they did buy back a little bit of debt, 1.2 billion, but still quite a bit higher than it was 10 years ago. They do consistently produce cash. That's good. Their dividends, about 923 million payout, but they have been increasing shares quite a bit. Whoa, that's interesting. So over here, let's say 2.2 billion. They issued shares to get about 3 billion. I guess their cash balance just increased. Yeah. Okay. Interesting. All right. So, huh. Okay. So dividend. As for the dividend, I mean, I could see them increase this at 2%. Looks like that's kind of what they've done historically. If we looked at payout right there, 923 million, 2.2 billion, roughly 2 billion, 2.2 billion. It's less than 50% for a company that likely doesn't have too many growth opportunities, as you could see from its revenue almost being flat after 10 years. It's fine to have a big payout, but I'd want them to start. They have such healthy cash. I don't know why they're issuing so much debt. Um, just interesting to see that. But I think to start making some assumptions here, let's see, on the revenue side, I mean, I assume they just grow pretty much with inflation. I don't know why it hasn't done it in the past, but and then 13p because at that time they might not. They'll have pretty similar growth to inflation, maybe a little bit less, and that huge enterprise value compared to market cap is not super attractive. I mean, they have about 2 billion, so it's like 10 times free cash flow is how much debt they have. If we look at like a 5 year average, maybe a little less, maybe 8 to 10 times, but I definitely like it to be under five, well under five, if I can. Looks like, I mean, the interest expense is going to be increased quite a bit based on this 23 billion. So even if it goes up 2%, that's 500 million, which, I mean, that's 25% of their cash flow. So kind of going all over the place here. That's my bad. But let's look at margins quick. 919 on average. Wow, their free cash flow is so much different. I wonder why that is. I guess I'll presume that their earnings will converge kind of into their what their free cash flow margin is. They've been increasing shares so much. It's just interesting to me to see why a company would be issuing a lot of debt and a lot of shares when they do produce a good amount of free cash flow and their payout is less than 50%. So this other column I'd really have to look into to see what is going into that, because here 2.2 billion and then they pay out 5.3 in other. I definitely want to see what's in this other, because that's why they're issuing shares and issuing debt. So, all right, well, weird stock, a little bit confusing currently, but no worries because it's 40% off of where I'd want to even think about getting into it more with a 15% return on the stock. So for me, I'm just waiting, and yeah, it was a confusing look, but it really doesn't mean anything because if it's not if it's not at a price that I feel is attractive, then I'm not going to waste my time until it does get to that price. So thank you, and hope you have a good rest of your day.